25 seconds away from the opening bell to wrap up a really interesting week in this equity market. Equity futures just slightly positive. Some positive follow-through after the monster gains in yesterday's session. On the S&P 500 right now, positive by 0.1%. On the Nasdaq, up by around about 0.3. There's the opening bell. Switch to the board and get to the bond market. Yields look like this, higher by a single basis point. 383 on a 10-year. On a 2-year, the data looking good again relative to expectations. Mike McKee will give you a run through of that a little bit later in the program. We'll catch up with him again in 15 minutes or so. But we have got on our hands right here 11 consecutive days of high yields at the front end of the curve. The 2-year up another 4, looking at 460. We're talking about 70 basis points worth of weight added onto the front end of the curve in 11 sessions. And with that, some dollar strength. A challenge to the euro bulls. The euro breaking down to about 107, trying to bounce. It's a pretty tame bounce. 107.32, positive by not even 0.1%. And crude struggling to get back to 73, 72.83, positive by about 1.4%. Around the open then, 40 seconds into the session, your broader equity market positive by 0.2% on the S&P. On the Nasdaq, up by 0.3. One stock to watch at the open is the Gap, reporting better than expected results, with cost-cutting measures improving the retailer's profitability. The interim CEO saying, quote, "We continue to take the necessary actions to drive critical change, ultimately getting us back on a path towards delivering consistent long-term results." Abby has more. Hey, Abby.
Hey, John. Well, they did put up a surprise profit. They put up a penny versus the estimated loss of 16 cents. And as you mentioned, it had everything to do with cost cutting along with discounts. Now, relative to the cost cutting, they had a reduced headcount. They also trimmed other expenses. On the discounts, it had to do with freight and other types of discounting their merchandise less. But it's a top line issue. So this stock going into today down more than 30% and 11% short interest. So today's pop up about 10% right now could be a short squeeze. The question is whether or not they can return the Banana Republic and the Athleta to greater growth. Comps at both of those stores declined. Old Navy down just a little bit. The Gap up 1%. So they need to get the merchandise right so that they can also get the top line growth that they need for that long-term turnaround that they're talking about. But perhaps this profit, some of the bottom line coming into view in the way that analysts would like to see, a good start. John.
Nice pop for that name, up almost 12% right now. Abby, thank you. Jeffrey's weighing in on this story and writing the following. We view these results and the company's reiterated guidance as encouraging. However, we're exercising some level of caution given the uncertain macro environment and ongoing business restructuring. They reiterate their hold rating. That name, though, still up by more than 10% in the first 2 minutes of trading. Sticking with retail earnings, Costco delivering mixed results, topping earnings estimates, but reporting weaker than estimated revenue and comparable sales. Simone Foxman has more. Hey, Simone.
Yeah, John, it took markets a little bit in terms of digesting this. There was a sell-off initially, but then once traders realized there was a pretty large one-time 50-cent per share charge, shares recovered for the most part and now are a little bit higher on the day. But there were signs of weakness in this business, especially in the United States, where Costco gets 74% of its revenue. U.S. comparable sales, excluding fuel and currencies, up 1.8%. The estimate had been for 3.5%. Really, Costco, though, echoing the message we've heard from a lot of big box retailers: smaller ticket size, stronger buying on discretionary stuff, but not so much buying on the bigger margin sorts of things like electronics, home furnishings. A deceleration in sales growth, though, may have been priced in. The company had its weakest sales growth in March in 3 years, and it didn't accelerate that much in April. Maybe that's why we're seeing some positive numbers today. Still, analysts, though, very positive on the stock. There were 27 buy ratings, 14 hold ratings, but 0 sell ratings going into this earnings.
Amazing. In line with the broader market, just about positive, up by 0.3%. Simone, thank you. The broader market up by 0.3%. The Nasdaq up by 0.4%. Let's sit on the Nasdaq and turn to tech. Workday lifting its subscription revenue forecast for the rest of the year, easing anxiety over the appetite for corporate software spending. Katie has more. Hey, Katie.
Hey, John. Yeah, Workday off to the races this morning. Just some context. This is a company that makes software for HR management, among other things. And like you said, it lifted its guidance for that annual subscription subscription revenue. That is a key metric for this company. Those new numbers are $6.55 billion to $6.58 billion. So bumping up the previous lower end of that range. And like you said, going a long way towards reassuring investors that there's still appetite out there among corporations. Remember, we got some results from Snowflake earlier this week that had fanned concerns, but these Workday numbers went a long way towards, again, reassuring investors, not just in the guidance, but also in the previous quarter's results. Fiscal first quarter sales rose 17%, topping estimates. Subscription revenue jumped 20%, and to boot, the company named a new CFO as well. You've seen sell-side analysts just clamoring to raise their price targets. I've seen 3 of them already, and you can see that Workday shares of about 9% at the moment.
The third best performing name on the NASDAQ 100 currently. Katie, thanks for that. Let's get to the number one. It's this one. Marvell recording its biggest intraday jump since 2001, saying it expects revenue from, guess what, AI technology to soar throughout the year. Alex Webb has more. Morning, Alex.
Good morning, John. It's really the tale of what we've been seeing with NVIDIA yesterday, the stellar numbers coming out of there. Marvell is in a slightly different space from NVIDIA, but it does make some chips that have AI applications, and that really seems to be what investors are picking up on. The key thing they're saying is that AI revenue will double in fiscal 2024. When you look at the numbers a little bit more closely, it was $200 million in the previous year, so maybe looking at a doubling to $400 million. That's clearly not nothing, but in the scope of more than $5 billion in annual revenue, it is by no means the lion's share. Nonetheless, we've been seeing growth across some of the other areas. Consumer revenue up, carrier infrastructure revenue up, enterprise networking revenue up, automotive also up. All those things clearly underlying businesses that continue to do pretty well. We do not expect this to be the last time we hear a company bigging up their AI prospects, even if some might say they're not as big as you would think.
I wonder how much, Alex, that is part of the move today, just talking about it. Alex, the move yesterday in NVIDIA, can we finish on that? Alex, what did you make of that move? Just historic.
It's huge numbers. You know, the amount they gained yesterday was more than the entirety of Intel, which was for the longest time the world's biggest chip maker. We're seeing a huge sea change. Talking to analysts today, NVIDIA has placed itself so incredibly cannily, for, encouraging people to use their entire chipsets if they want to get a piece of the AI business, if they want to get a piece of their AI technology as well. I think the key thing we take away here is what we've learned about what AI is going to be as a business. It is a cloud business right now. It is a way for Google, Microsoft to get people using their clouds. That's why they're investing so heavily in NVIDIA, and that dictates the way that AI is being distributed to the world.
Interesting. Alex, just wonderful coverage, mate, as always. Out of London, Alex Webb there on NVIDIA and other names as well. That helped drive the NASDAQ 100 to its biggest one-day gain for the month of May just yesterday. Some positive follow-through. The NASDAQ up by 0.5%, the S&P up by 0.3%. As tech stocks mount up, our bearish views beginning to mount down. Morgan Stanley's Andrew Sliman now saying stocks could hit 4,600 by year end as FOMO starts kicking in. Quote, if it gets to October and I haven't made money for my clients, then I would start to get nervous. My conjecture is cash starts to get back into the market later into the year. Bank of America's Savita Subramanian boosting her year-end target to 4,300, saying the skeptics are making something out of nothing.
Narrow breath is not a precursor for doom and gloom. I think it's kind of a false negative. And then when you look at valuations right now, they look high, which is another reason nobody wants to buy stocks. But valuations generally look high when you're in an earnings recession, which we are. If we are in this sticky inflationary environment, do you really want to be in cash or bonds? Don't you want to be in stocks that participate in inflation?
Morgan Stanley's Mike Wilson pushing back.
The bear market is continuing, okay? This is what bear markets do. They're designed to fool you, confuse you, make you do things you don't want to do, chase things at the wrong time, probably sell them at the wrong time. We think that the fundamental case does not support, where stocks are trading today, whether it's at the index level or at the single stock level, and the second half is going to be a bit choppier and probably downward in the index.
Back with us on this story, Krish Mamani, Seema Shah. Seema, I wanted to come to you on this and ask you specifically, does narrow breadth matter to you?
Oh my goodness, yes, it really matters. Look, we have, as I said before, we have a view for a recession, and that implicitly should mean that the S&P 500 will go down. And yet, then you have the narrow breadth. So at this point in time, it is so important for investors to not just be looking at the index level, but looking deep under. For us, large cap, mega cap tech stocks, or specifically mega cap growth, I should say, we're always going to do well in this cyclical environment, right? You have a slowdown approaching, you have the Fed at least approaching the end of the cycle, and then of course you have the rest of the global economy looking better. So that implicitly should do well for mega cap tech, and then you add in the AI story, and that's a secular driver. So there's a number of reasons why mega cap tech should be doing well. But it doesn't mean that the rest of the market is going to do well. And certainly if you look under the cover, then actually the other sectors are really struggling. So actually the recession call, the broader market story of weakness does continue to drive through. But that narrow breadth is a number that you're going to see if you look at the screen. You just look at the S&P 500 and you're going to think, wow, things are fantastic.
Well, you can look at the S&P 500, or as some people have joked, many people have joked over the last week, you can look at the S&P 495. Now, Krishna, when you look at those two things right now, I think you could have said the same thing for much of the last 10 years at times. 5 big names driving the stock market higher. What's different this time?
Well, so I think Savita is right. That is, it always seems like breadth is narrow when you are at this point of transition. I think what the question we have to ask ourselves is tech going to go down, or rest of the market is going to catch up to tech, at least some parts of the rest of the market catching up to tech. And I think that really ends up being a call on whether we are going to have a recession or not. And I think on that front, it's quite clear, at least for the, Mike Wilson was talking about the second half. I think second half, from a growth perspective, there's really no challenge whatsoever. If there is any challenge, it'll be that the rate cuts would be priced out. I don't think that is so bad for the 495.
Krishna, your time horizon's different, and time horizon matters. You've got a tactical call, upside risk, and I've been asking this week, is the bigger risk a mount up or a mount down? Do you still think it's that upside risk that's still underappreciated?
Yes, I think the upside risk to the market is much larger than the downside risk. The downside risk was contingent on some signs of a recession, and we don't really see that. Stocks are nominal instruments. When you have this level of nominal growth, expecting that things are going to just crater, I don't think is a realistic thought.
The rally in these names has been so polarizing. As you both know, Meta up more than 100%, Nvidia's more than doubled so far year to date, and it is May 26th. We've got some runway here to get to the end of the year. Seema, I just wonder, do these AI members, these AI winners, speak to another era of US exceptionalism in the equity market? That was where the outperformance was for the last decade. And those names did not exist in Europe. And I feel like this is the early innings of having this conversation again. Is that what this is?
I think you're absolutely right. I think for a little bit of time at the beginning of the year when Europe was doing well, there were maybe some considerations that actually this could be shifting into a more European decade. And we've just seen from technology that, look, Europe just doesn't have the same kind of names. It doesn't have the same kind of strength. So from that perspective, AI, as long as it's not going to go away, as long as regulation doesn't come in and completely clamp it down, then this is suggesting that the US market is a place to be if you're looking out there for a 10-year horizon, absolutely.
And Krishna, what do you think the message that is being sent right now from the likes of Nvidia, Meta, Microsoft, to people who are long the Euro Stoxx 50?
Well, the message is pretty simple. I think European economy is slowing down for sure, and Germany is probably the best example of that. And if bad things happen in China, it gets impacted a lot more. I think the developed market away from the U.S. at the end of the day still very much remains a trade. And it comes and goes. I think from a longer-term perspective, the likelihood that other markets away from U.S. are going to do materially better, simply driven by valuation, I don't think is a really good thesis.
We've heard that argument a few times, haven't we, Krishna, over the years?
Yes, we have.
Krishna Mamani, Seema Shah, to the two of you, wonderful as always. What an interesting moment for this market. It's such a polarizing story right now. If you're in it, you've been loving it. If you're out of it, you're wondering if you should get in or carry on throwing mud at it. Your equity market right now, 13 minutes into the session, positive by 0.6% on both the S&P and on the Nasdaq too. Coming up, more resilient data ahead of the Fed's June meeting.
I think this Fed will hike because it is overly data dependent, and the data clearly, short-term data clearly says hike.
That conversation coming up.
I think this Fed will hike because it is overly data dependent, and the data clearly, short-term data clearly says hike, even though your measures, your policy measures have a lag in terms of effects. And this is also a Fed that's so worried about its credibility that it's not going to be wanting to fall behind even more in the perception of people. And it doesn't have the confidence to stand up and say, look, we operate with a lag and we don't want another policy mistake.
Mohammed Al-Arian on the program in the last hour saying they will hike in June. That's his expectation as things stand. As things stand, there's some runway before we get to June 14th. We have payrolls on June 2nd, CPI on June 13th, and you hope that we get a debt ceiling ex-date somewhere in between and a deal before we hit it. That's going to be the story over the next couple of weeks. Mike McKee back with us for more. Morning, Mike.
Good morning, John. Well, the numbers that came in, to quote the late, great Alec Guinness, are not the droids the Fed is looking for. We saw personal income and personal spending both rise in April over March, and inflation rose on a headline and core basis. This is not what the Fed had anticipated, even though they thought we might have some volatility. And here's a really interesting number for you. We saw goods spending rise more than services spending, and we had thought there had been a rotation out of goods. It looks like that is turning around. So that could be a problem down the road if we still start to see goods inflation rise some more. By the way, that PCE core services ex-housing number that is sort of Jay Powell's talisman, that rose on a month-over-month and headline basis during the month of April. So what we're looking for now is the next in the series of numbers you mentioned, jobs. Next week, 188,000. Now that is up from earlier this week. They do see, the economists we survey, a slight rise in unemployment, but not a big change in average hourly earnings. So it looks like status quo. And if Mohammed says that means the data are saying raise rates, the Fed's probably going to want to raise rates.
Mike, amazing, isn't it? That unemployment rate, even with that tick high, is still a full point where the Fed expects it will be by year end.
Yeah, and there's no way we're going to get the kind of jobs numbers they're looking at by year end now. So this June meeting is one in which they give us new economic forecasts. It will be interesting to see what they come up with.
Hyper-focused on those projections, the summary of economic projections, the SCP in that release. Mike, thank you, sir. Just wonderful work. Tremendous as always from Mike McKee on the Federal Reserve and on the economy. Here are the job cuts. JP Morgan notifying 1,000 First Republic employees they aren't being given jobs. Bloomberg breaking the news and reporting that 85% of the failed bank's employees were offered full-time or transitional roles. JP Morgan said this: since our acquisition of First Republic on May 1st, we've been transparent with their employees and kept our promise to update them on their employment status within 30 days. We recognize that they have been under stress and uncertainty since March and hope that today will bring clarity and closure. Shanali, the White Knight, sharpens that sword.
The sword is certainly sharpened over there at JP Morgan. Remember, JP Morgan, John, has expanded its headcount over the last couple of years. They've really bucked the trend already when you've seen about the job cuts that have reduced headcount in certain places on Wall Street. JP Morgan just got bigger. Now with First Republic, remember, there will be roles that are duplicated as they bring in First Republic. And even among the jobs that are offered to First Republic employees here, this is about 85% of the 7,000 employees at First Republic. There are many that are offered as transitional roles as well. That is transitional roles between the space of 3 months to a full year. So even in the next year or so, there are going to be questions about how many of these First Republic employees really stay on. This chart is pretty extraordinary, and a really fun fact here. This is the compensation per head count. And at First Republic, you see that it is much more than over at JP Morgan. Remember, JP Morgan is a very large bank with a lot of consumer businesses here as well, so that pay is very dispersed among a wide array of bankers. First Republic was known to bank wealthy individuals and therefore have a lot of kind of private wealth type bankers, but the pay is large relative to the pay per head count you see at JP Morgan. That is what you would expect at a firm like that. JP Morgan is already a story about keeping expenses under control. More on this story ahead, John.
Well, speaking of another story, let's squeeze this in. Some reading for the beach this weekend. Fantastic story written by Shanali and the team. Shanali, the headline: infamous hedge fund trade draws fresh scrutiny scrutiny during the debt saga. Just give us a tease of what people can expect in that piece.
Yeah, you have to keep an eye on it, John, because if you're JP Morgan, Citigroup, Goldman Sachs, or any prime broker on Wall Street, you're probably getting questions here from regulators because they're worried. The Fed has had to step in before on highly levered trades that hedge funds have made in the Treasury market. The Treasury market has been very volatile. People are worried about overnight financing. People will continue to be worried about overnight financing. Ripple effects are really still unknown, but hedge funds are certainly levered to this market. Crowded trades in there, John.
Very cool. You can find that story on the Bloomberg Terminal and on Bloomberg.com. Shanali, thank you, as always. Let's get you some sector price action. The equity market in this session highs the Nasdaq up by another 0.8%. Here's Abby.
So not surprisingly, John, today with today's gain, a two-day gain for the S&P 500, most sectors are higher, led by tech, up more than 1%. We also have discretionary materials, industrials higher. The only sector lower, utilities. This as yields continue to surge higher. Those dividends look less attractive. Very interesting, though, on the week, the S&P 500 is down about 0.7%, and almost all sectors are lower except for technology. That's true, too, on the year. I was shocked by this. It would actually support the idea that we're going sideways or even down. Internal breadth that you were talking about, not great here. Tech up 32%. Take a look at these other sectors. They are lower, John.
That's some real divergence. Abby, thank you for that. Coming up, your trading diary. Once again, same old story. The Nasdaq leads. Nasdaq 100 up by 1%. About 26 minutes into the session, the S&P doing okay as well, up by 0.6. That's the price action. Here's the trading diary. Coming up, UMich Sentiment Survey, top of the hour to next week. Markets closed, of course, for Memorial Day on Monday. U.S. consumer confidence numbers out on Tuesday, Thursday. Secretary Yellen's ex-date, plus ISM's manufacturing. And Friday is the U.S. payrolls report. From New York City, that does it for me. Thank you for choosing Bloomberg TV, and please do enjoy the long weekend. I'll catch up with you on Tuesday. This was the countdown to the Open. This is Bloomberg.
from the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, May 26th. Here are the top market stories we are following for you at this hour. Deal or no deal? Debt ceiling negotiators are closer to compromise on spending, but there's no agreement yet with the X-date looming. We'll look at how to hedge into the weekend. Still chugging along, hot inflation and consumer spending data show economic resilience and sends yields higher. What does it mean for the Fed's June move? And Marvell Us, the chip maker, is the latest to cash in on the AI boom as Citi raises U.S. stocks to neutral and tech to overweight because of artificial intelligence exposure. From Washington, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, happy Friday. Not just any Friday, of course, a Friday before a long weekend with a debt ceiling deal hanging over our heads.
So I'm going to point out to viewers, Kaylee Lyons is here. That means generally you want to buckle up. It generally means that we're going to get some breaking news. It generally means that things are going to go, well, not sideways, but maybe in directions that we didn't expect. And I have to point out as well that she's at the epicenter of the action this weekend. It is all in D.C. Funnily enough, Kaylee Lyons, that's where we find you.
Yeah, and it hasn't been a fun couple of weeks, to be honest, Guy, as we have just tracked the progress or the lack thereof on the debt ceiling. It seems, though, that we're getting closer, and as you allude to, we're waiting for news today, potentially.
We've got some news right now, and that comes out of the University of Michigan. It comes in the form of actually a slightly better inflation read. So the one-year inflation number, and these are the final data that we're getting for May. The original number was 4.5. This is the one-year number. It ticks back down again to 4.2. It's very gasoline dependent, this number. The longer-term inflation expectation had ticked up to 3.2 in the prior number. This number is stable at 3.1. But as Kaylee, as we've been learning, the data are certainly pointing us in the direction of potentially more Fed hikes. That's what we got from the PCE data today. We'll come back. We'll talk about that a little bit later on. The market now getting to the point where it's getting comfortable with the idea of a June hike. But let's get back to really where we started the show. What could possibly go wrong over this long weekend that we have coming towards us, both here in the UK and over in the United States? As I've already suggested, you want to buckle up. Kaylee Lyons is in the house. We got a difficult weekend potentially coming towards us. Let's kick around how the market should be viewing what is about to happen. Liz McCormick and Bloomberg's Mike McKee join us. But Kaylee, I want to start with you first of all. As we've said, you've been tracking this. You're in the epicenter of the action. What is your perspective on what could go wrong over this weekend? Do we get a deal or do we get no deal?
Well, it seems more and more likely, Guy, that we are going to get a deal. We understand that the two sides are coming closer together on a compromise of spending caps and lifting the debt ceiling for a 2-year period, maybe the defense spending increase that the Biden administration was looking for. But it's not to say there aren't still things that they're haggling over and that there isn't room for error. We could see another walkout of negotiations like we saw last weekend. And then, of course, there's the chance that once a deal has come to handshake between the two parties, President Biden and Speaker McCarthy, the actual members of Congress, their caucuses may not like it, and they're the ones that still have to vote for it to make it become law, and the clock is ticking, as we all know.
So Liz, let's bring you in on this and figure out exactly what is happening here. From a market perspective, you find yourself in a situation where it looks like we're going to get a deal, but we've all got long memories. We remember things like TARP. We remember that a deal is not a deal until it's a deal. How do you think markets should view this?
Yeah, and I fear, are we dooming ourselves talking about this, that they're going to have a fumble? But yeah, the market has long memories, and I don't think anyone's going to fully believe it until it's all signed on the dotted line. And like Kaylee laid out, there's a couple potential pitfalls already, but the market is kind of trading, kind of trying to focus on the data, like you mentioned, that came out this morning, and looking into that June meeting. But if everything crumbles, I think people want to have a long weekend, and they're going to be checking their Bloombergs, and they're going to be worried that something blows up,
Yeah, Liz, I'm right there with everybody else where I'd really like to just not work at all this weekend, but I know I'm going to be attached to my phone, especially if we don't get anything announced by the end of today, Mike. So how do you view this from an economic risk standpoint? We've already had the warning from Fitch earlier this week. We now have this data that kind of muddles the picture for the Federal Reserve. It seems like the risk is maybe higher than a sanguine equity market would indicate.
I don't know. I think the risk is really on the Fed side, whether or not they raise rates more and by how much. You look at what could happen. Obviously, if the deal doesn't happen, then we have a big problem, and it's something that's hard to quantify other than to use adjectives like, tremendous issues or Armageddon, something like that. If a deal does happen, then from the contours that we have been seeing, it doesn't look like it will really have any effect on the economy at all. They're mostly shuffling money around rather than actually cutting spending that would reduce growth. The Fed is going to be the game there in trying to reduce growth because of these inflation numbers that have come out.
Okay, let's go to the inflation numbers, Mike, and just talk a little bit about what is happening. We talked to Joan Shu a few weeks ago when the first UMich numbers came out, and she suggested that maybe actually the consumer confidence numbers were being held back by concerns around what was happening in D.C. I've just seen the latest headline numbers. They come through. Inflation's fairly stable, but the sentiment index ticks up to 59.2. If that's with no deal, what does consumer confidence look like with a deal, and how is the Fed going to pull all of this together?
Well, I don't really want to rain on the University of Michigan, but it doesn't have a lot of correlation with what is actually going to happen in the consumer economy going forward. The famous quote from Alan Greenspan was, "We watch what they do, not what they say." Probably a lot has to do with the change has to do with the drop in gasoline prices as we get close to this Memorial Day weekend. We're $1 lower than we were at this point last year. And so people are feeling a little bit better about that, but does it tell us what they're going to spend or not spend? Not really. Remember, you just mentioned how the consumer confidence numbers had fallen, but we saw a big increase in consumer spending during the month of April. So at this point, it looks like people are still out there willing to spend. The business numbers that came in the durable goods orders today show business investment maybe picking up. This economy is a lot stronger than the Fed and others anticipated. So we've just got to see what it's going to take to slow inflation down, because it's just kind of sticking around, to make a play on the word sticky.
Good one. And of course, you're seeing it show up, that stickiness in the bond market with yields moving higher. Liz, we're now at 4.56 on the 2-year Treasury yield. It raises the question, though, if we're thinking of things that may go wrong this weekend, are things going wrong something that would mean a bid into the bond market or more selling pressure? Because we know what happened in 2011.
Well, that's the thing, and that's what makes it more complicated. I would say in the short end, there's still more focus on if things go wrong. We still have that data. It doesn't mean the Fed's going to ease. They may have to jump in and, do some support programs. But people have been buying the long end. If there's a flight to safety, the whole deal falls apart. Like you said, in 2011, even with the downgrade from S&P, people bought treasuries. But I think also in the weeds of if there's a deal, like Mike said, at first it looked like, a deal may be really a headwind to the economy. Now it's looking like not so bad. So if we get a deal and it's not such a hit to the economy, then with the data we're seeing, you're going to see those Fed bets get ginned up again. We're already priced at 25 basis points of hikes comes at least in June or July. For a while, a few weeks ago, there was no hikes priced in. So I think that's the sticking point. But if there's no deal and everything falls apart, we hope that doesn't happen. You're definitely, I would think, in the long end, going to see some flight to safety. In the 2-year, I had an investor say to me this morning, if a deal goes through, remember, we might go back to 5%. I mean, who knows? That's one call. But, if Fed tightens again. So there's just a lot of risk in the market.
Liz, you have to wonder this weekend. Everybody gets out there. Everybody sees what's happening. The real economy looks really good. Everybody's enjoying themselves. There's long queues, TSA queues. Everybody's traveling. This feels like an economy that is still doing very well. The market's realization around this has come relatively quickly, and it has been brutal. We've seen a complete backup in yields, both here in the UK. You're seeing it certainly significantly over in the United States. As people come back from their holiday on Tuesday, What is the potential here for the market to for the pendulum to swing completely the other way? We're starting to price in hikes. How many more do you think we could price in here?
Well, somebody was reminding me, and we've all talked about that before, like, remember before SVB went down in early March, people were pricing terminal Fed funds rate is going to have to go above 6%. Some people saying well above 6%. So I think the risk is, like you said, you come back, oh, I had a great weekend, people spent money, bought lots of drinks, whatever, and things look good, a deal is done, and wow, the data still looks strong. Do we gin up the terminal rate to over 6% again? I think that's the risk. That, like somebody said, remember a recession was imminent, then it got pushed further back, then further back, and then so if the slowdown doesn't pan out and inflation remains sticky, like you guys just said, I just can't see why yields start going down for any good reason. So I think that is the risk, Guy, that we come in next week, deal is done, and again, Friday is the jobs report. If we get another strong jobs number, I just don't think yields can go lower.
All right, Bloomberg's Liz McCormick, as well as Bloomberg's Michael McKee, thank you both so much for joining us. Now, coming up, we're going to get more insight into our question of the day. What could go wrong over the long weekend? Charlie McElligott of Nomura is coming up with us next. This is Bloomberg.
The debt ceiling deadline closes
Back and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling.
They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
McCarthy and Biden, anything can happen when they meet. They're going to meet more often, and there are adults in the room, even though they're young staffers in the White House that think they can run this negotiation. I hope there are adults in the room that understand the depth and the implications of doing something as stupid as defaulting.
That was Kyle Bass, Heyman Capital founder and CIO, speaking with Guy and Alex yesterday on the ongoing debt ceiling negotiations that are still ongoing as we head into the weekend. So that brings us to our question of the day. What could go wrong over the long weekend. With us now is Charlie McElligott, Nomura Managing Director for Cross Asset Strategy. So Charlie, I guess it's really a two-part question. What could go wrong, and how do you position for it?
Appreciate being on, everybody. So look, there has been clearly in the months building up into this, and the anticipated saber rattling with regards to the debt ceiling discussion, while too you have this, perception of imminent recession in the background, while too you have this regional bank's profitability crisis, which then accelerates the credit and lending slowdown, which feeds into the recession risk. There have been all these neon swans, I like to call them, right? None of this stuff is coming out of left field. And what it's done is create an over-hedging dynamic into a risk event that now very likely is again failing to materialize. So over the past week in markets, you've seen a lot of these trades that benefited, these hedges that benefited, whether it was buying duration or buying gold, trades that people had on that was, kind of short the dollar. All that stuff has really come off pretty substantially already into this, because along the way, quite remarkably, the feedback from the DC consultants and whatnot, people that are very close to the negotiations, has been very constructive. So in my mind, it's actually not about these hedges that have been put on and are now leaking as the market rallies higher and equities and bonds have sold off, rather precipitously. It's actually about the forward risk in the months ahead, because this deal is getting done. Now there's this liquidity drain concern in the market that we can speak about.
Charlie, and we're also going to have to contend with coming back next week and dealing with the fact that we've got University of Michigan data that probably points to another Fed rate hike. The consumer's still in great shape. Inflation reasonably stable. You've just seen, obviously, the core PCE numbers coming through. We've got payrolls coming up next week. Is the real risk this weekend is that we all enjoy a beer and a barbecue. We come back on Tuesday morning, and we realize actually we're going to be dealing with significantly higher rates from here. We're going to have less liquidity to go through that process with, and that could be potentially an ugly market setup.
That's exactly where my head is, Guy. So, we're in that squeeze all the good news blood from the stone moment, between this and obviously that very idiosyncratic AI NVIDIA rally going on in the background. And as I said, perversely, this then creates two major headwinds for the market. The first is, as you touched on, we are real-time repricing the Fed path. Okay, people have come into these last few months where they've perceived the end of the Fed tightening cycle and have been over-anticipating, this slowdown that has failed to materialize, and we keep seeing iterated with latest data. They've kept pricing in the potential for a deep cut if one of these left tail events, i.e. a debt ceiling fail, were to develop. And the fact is that now has been repriced much smaller probability-wise, and instead of that perception of, Fed is pausing and then, if anything, cutting after, now the market has to price in the complete opposite dynamic. There might not even be a pause. You're actually having to add in hikes. You're adding in terminal. And you're seeing that right now. The last couple of days, terminal rates moving higher. This data is just too strong. Super core inflation came in at, spot 4.29 this morning. That was off of a spot 2.9 last month. So, acceleration in inflation is now bringing the Fed back to the table, and that's definitely part of that major headwind going forward, on top of the fact that after this deal gets done, the Treasury has to replenish funds, and that's going to mean a ton. We're talking trillion plus of short-term bill issuance in coming months that could then crowd out risk assets.
Yeah, there's the liquidity challenges, and then we also have to consider if ultimately what this deal brings is cuts to spending, there's a certain pullback in the fiscal impulse as well that could have growth implications. Charlie, I do want to ask you, though, about the U.S. dollar specifically, because even if we get a deal, if it's passed in time, the debt ceiling is raised, it was still incredibly difficult for the U.S. to maintain the ability to pay all of its bills. And I just wonder if we start to question the full faith and credit of the United States just because it is so difficult and we've had to do this so many times and there's no indication it won't be like this again in the future. Can the dollar still reign dominant in this kind of politically difficult environment in the U.S.?
Yeah, the dollar's demise is perpetually overplayed in my mind. It's the world's reserve currency for a reason. And, something I've spoken about in the show before with Alex and Guy has been this idea of the dollar smile. And that is that the dollar tends to rise both in a better growth type of environment which ironically is where the U.S. is shifting back into as we speak right now, right? And with that, interest rates move higher, right? So that goes hand in hand. People are repricing the Fed path higher now because the data is staying so strong. Conversely, it also goes higher at the other end of the smile when there's a risk-off event, which was part of this rally that blew up so much short dollar trade that has been out there year to date. Everybody came in, wanted to short the dollar on that thesis that we were nearing the end of the Fed tightening cycle, that emerging markets were taking off, that Europe was taking off, that China was taking off after reopen. And what you've seen over the past couple of weeks are those trades getting stopped out as the dollar squeezes higher and people have to unwind those positions because, again, U.S. exceptionalism is proving true, as well as, obviously, the Fed not having finished their job yet with regards to this still above trend inflation dynamic that's a problem for them.
So, Charlie, you got nice relaxing plans for the weekend? You're not going to be worrying by the sounds of things. We'll deal with that Tuesday. What are you going to be doing?
We're going back to the motherland of Ohio. We're going to have beers and hot dogs with the family. I'm not going to worry about the debt ceiling at all. We'll come back in, and I think the next couple of weeks, we can start worrying again once this deal goes on the headline. Okay. We're going to have people forced into the market, and after that, then we can talk about the liquidity drain and have some more nervous conversations. But now is the time to relax.
Okay, beers, barbecues, that sounds fantastic. Enjoy it, Charlie. We really appreciate your time ahead of the long weekend. Thank you very much indeed. Charlie McGilligan of Nomura. Still ahead, well, the long weekend. Marvell shares soaring. We can't get away from this story. The chipmaker saying AI revenue for 2024 would be at least double. More on that next. The startup is coming. This is Bloomberg.
It's about 23 minutes past 7 on the West Coast, so let's get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-host Caroline Hyde. And Caroline, we got to talk about the AI magic beans that are hitting yet another company. It was NVIDIA yesterday, up 24%. Now Marvell up 25%, 26% now on the day. And I have to wonder, is it just using the magic word or is this real?
No such thing as an overnight success, but boy, does it feel like it right now, doesn't it? I mean, Marvell
given us actual, real, tangible numbers, saying, look, they will likely more than double the revenue from AI-related products over the next fiscal year. So that's going from 200 million to 400 million. But then that's going to itself double again. We are talking about explosive growth overall because they can't get enough of it. In particular, you had the CEO really just talking about how they'd already leaned into the area of AI, and that's what's really building at the moment. They're talking about network connectivity products. They're talking about emerging cloud-optimized silicon platform that they've lent into. So these are CEOs that have basically managed to see this one coming, but so too is the rest of the market. I mean, there was a great piece by John Authers who just says, look, since 2012, some of those data and analysts over at the likes of Morgan Stanley and other key banks, and Deutsche Bank in particular, have highlighted that since 2012, you've seen the AI excitement building in labs. You have seen, actually, the patents been growing at an explosive rate. You've seen VCs been investing. It's just all been relatively quiet. Now in public markets, you're starting to see that shift. Of course, NVIDIA, $180 billion added in one day alone, now bigger than, well, two key US rivals, Intel and AMD put together, Guy.
Yeah, and Cathie Wood definitely saw that one coming, didn't she?
Well, she did a little while ago, and now, of course, she sold out of NVIDIA just as this ramp seemed to have happened, and so we're going to be putting those questions to her a little bit later. She's joining the technology show, just really trying to understand why she dialed back some of those bets in what is such an extraordinarily outperforming stock at the moment. So this is one key area you've got to keep an eye on NVIDIA. I mean, this is a CEO who has NVIDIA tattooed on his arm. He built the business, Jensen, of course, but Jensen back in, not 1993, but managed to really leverage new types of technology. The fact that he was in gaming, making sure that those joyous pictures that you get turn from code into an interaction that you use when you're gaming was so beautifully done. It drove that desire to get into NVIDIA, and now so does AI. But this is clearly a company that people cannot get enough of at the moment, Guy.
Absolutely. I look forward to hearing what Cathie Wood's response is when she gets that question from you a little bit later on. Caroline, looking forward to the show. Nothing to talk about on the technology show right now. Nothing at all. Caroline Hyde coming up in around 90 minutes' time. That's 5 p.m. UK time, noon in New York. Cathie Wood, the main guest. Kaylee, I do wonder, the next set of earnings calls, right? You're writing an earnings statement right now. You're thinking about how you're going to deal with your next set of earnings. AI, how many times are you going to mention those words? It could be the set of words that are going to generate a decent stock pop next time round as the algos scrape those earnings calls for details.
Yeah, like I said, magic beans. Coming up, we're going to talk about inflation.
There you go.
We are an hour into the U.S. trading session on this Friday before Memorial Day weekend. Bloomberg's Abigail Doolittle is tracking the moves. And Abigail, it doesn't look like people are nervous to take on risk.
Yeah, it does seem that way for sure, Kaylee. And interestingly, that's causing the S&P 500 to climb higher on the week. This is a one-week board, and just moments ago, the S&P 500 had been down on the week earlier this morning, down about 0.7%. The Russell 2000 is still down, but you can see this huge gain for the NASDAQ 100 and the stocks in particular chipped on NVIDIA, AI today, Marvell. So we're seeing a bit of a divergence. It's not showing as clearly with the S&P 500 up slightly now, but let's take a look at one potential pressure on stocks going forward. That said, we have seen these levels before not so long ago, right before the bank turmoil. We now have the 2-year yield close to 460 again over the last 11 days, rising 11 days in a row, backing up 66 basis points over that time period as investors start to bet that the July hike, that the Fed will hike in July, and maybe also June, so tightening truly back on the table. Now, relative to the week, this is interesting because we do have most sectors lower. The last time I looked, there were only 2 sectors higher, one of them just very fractionally, but tech on chips up 4.1%. But all the other sectors, or I should say most of the sectors, I think it was 7 or 8 of the sectors down more than 1%. Staples, materials, and utilities all there. Piece of this, for at least for staples and materials, or excuse me, staples and utilities having to do with yields backing up so much, those dividends looks less attractive. Nonetheless, that breadth is not great. And if we put this together in the Bloomberg terminal, what we are going to see is we are now looking at a 5th week of where the S&P 500 underperforms the NASDAQ 100 dramatically. The last time that we saw that, it was all the way back in 2021 and 2020. Guy, you will note, though, that both of those years were pretty bullish overall on the safety trade of big tech. Maybe we're entering a new phase, or maybe the bad breath suggests we're going to be going back down in the sideways trend.
What I think is incredible here, Abigail, is that there was once this fear that the technology sector would continue to be rate sensitive. We are disproving that on a daily basis at the moment. It does seem as if AI has superseded that concern around that sensitivity. Abigail Doolittle, thank you very much indeed. Abby will be back a little bit later. Let's pick up and carry on the conversation, though, around what is happening with U.S. inflation. It picked back up again in April. Consumers, look at the UMich numbers, look at what we got in terms of the spending data today. They're out there spending. You're going to see that this weekend. Flights are going to be full. People are going to be buying drinks. It's going to be fun by the sounds of things. The downside of that, and we come back to the punch bowl, is that potentially it puts another Fed rate hike in play this summer. We are now priced for another one this July. We priced out the cuts. Let's talk about how far we could go. Dominique Dworfrico from Macro Hive, senior strategist there, joins us now. Dominique, at one point, you had an 8% target for Fed funds rate. The market moved sharply away from even 6% for a while. We're now moving back in that direction. How far do you think we...
The Taylor rule has been a really great predictor of the terminal Fed funds rate. Since the 1970s, every Fed tightening cycle has ended when the Fed funds rate got close to the Taylor rule. So all I did a year and a few months ago was to say that it was likely that the Taylor rule was still relevant. My estimate of the Taylor rule is currently about 8%, and you want to take these models seriously but not too literally. So whether we will get to 8% or 7%, I'm not sure, but I would agree that my view has been vindicated by the data. I mean, look at what's happening to core services inflation, excluding housing. It's not going down. And look at what's happening to housing costs. We have rental indices like Zillow, apartment list. They are going up again. So I think obviously we're not going to get to the 8% in the next 6 months, but I stick to my long-term view. And by the way, in terms of the next fund move, I've had these calls that the Fed would hike 25 in June, assuming the debt ceiling crisis is resolved. I've had it since the last Fed meeting, so I stick to my guns.
Okay, well, Dominique, on the subject of the debt limit issue, we are just hearing from House Speaker Kevin McCarthy, who is speaking to reporters about debt limit negotiations, and he says he thinks the negotiators made progress last night. But if we bring around this fiscal issue into monetary policy, I could see that either way this shakes out. Either we don't get a deal done and potentially we see the first default on debt that the U.S. Would have ever done, or we do get a deal that brings spending cuts and potentially less impulse to growth along with it. Wouldn't either of those scenarios mean the Fed has to do less?
So there is no question that if we are in the middle of a debt ceiling crisis by the time of the June Fed meeting, they won't hike. On your broader point that fiscal policy has to get tighter, I couldn't agree more, because if you look at the budget deficit right now, it's 7% of GDP, which is enormous on its own right. But if you take into account the fact that unemployment is also the lowest in 50 years, fiscal policy is clearly out of control and it needs to be reined in a little bit. Now, I'm not sure we will end up in such an extreme situation through this debt ceiling issue. First of all, contrary to popular perception, I don't believe that hitting the X date means a default. On the contrary, if we hit the X date, what's going to happen, and we know it from past Fed transcript, the Treasury is going to prioritize debt service payments. The U.S. has plenty of cash to cover interest payments. That's not an issue.
Yeah.
The bigger issue is whether the U.S. will be able to roll over its debt. And there, the Fed...
But Dominique, if I could just mention on the issue of prioritization, Treasury Secretary Yellen has called that a default by another name, and even Fitch Ratings, when issuing that Ratings Watch negative earlier this week, said prioritization would not be consistent with a AAA rating and could result in a downgrade. So I just wonder if a downgrade would be just as bad.
So, no, I mean, look at the last time the US got downgraded. This was in 2011. There was a big negative market reaction the day it happened. And since then, show me the market where we can see the downgrade of the US. The bottom line is that there is no alternative to the dollar. The dollar will remain the global currency, whether or not some rating analyst decides to downgrade. No, and to come back to your issue of the default, I would argue that a default is a non-payment of interest or principal on the debt. And I can't see this happening even if we hit the X date, because the Treasury has enough cash, more than enough cash to cover interest, and the Fed is going to make sure that the Treasury is able to roll over its debt. And as you know, don't fight the Fed. I mean, this has proven good advice. So I disagree that this is default for by another name.
Dominique, let me just ask you one final quick question. The British Chancellor of the Exchequer, our Finance Minister, Jeremy Hunt, said something I don't think I've ever heard a Finance Minister say before, a little earlier, talking to Sky News here in the UK. He was asked about the Bank of England and the Bank of England raising rates, and was basically asked, would you prefer a recession to ongoing high inflation? And he basically said yes. He'd rather the Bank of England hit inflation hard and potentially delivered a recession. Is it going to take a recession to bring inflation back down to target? How bad are those recessions going to need to be? And when on earth do you think they actually come, particularly in the United States? The US consumer seems to be in good shape right now.
Unfortunately, because there is this feedback loop between wages and prices. Wages are high because prices are high, and vice versa. The only way to bring inflation back to target is going to be a recession. And that's going to take a much tougher Fed policies than what we have now. And I don't think the Fed is ready for that yet. So we're going to see inflation probably creeping up in the second half, and the Fed eventually biting the bullet. And so my expectation is that we will move towards the Taylor rule value of the Fed funds rate towards 8% sometime in the latter part of this year, maybe the first quarter of next year, and then 2024, in my view, is the year of the recession.
All right, Dominique, thank you so much for joining us today. That's Dominique Duafrico, Macro Hive Senior Strategist. We appreciate your time. Now, coming up, we're going to turn to the strength we are seeing in Japanese stocks. The Nikkei's recent rally pushed it ahead of the world's major benchmarks. Strategist from Goldman and Nomura says it has further to run. We'll discuss with Shoki Omori of Mizuho Securities next. This is Bloomberg. Japanese stocks have fallen for 4 straight days after hitting a multi-decade high on Monday. Bloomberg's Abigail Doolittle is looking at the moves in that region. Abigail?
Yeah, Kelly, it's interesting because we do on the week have the TOPIX down 0.7%, the first down week in 7 weeks. But to your point, last week at its highest level since 1990, and this is actually the 10-year yield here in the U.S. It's backing up 16 basis points. But JGBs, they're up, the yield up modestly, a little bit less of a sell-off. I would say a pullback for JGBs. As for an overnight inflation read in Tokyo, it's showing a little bit of moderation coming off of the recent recent peak, closer to 4%. So that could be a positive, a fundamental positive here that we're coming down off of that inflation high. And then finally, this is interesting because we have the yen, which had been rallying earlier from the peak of last year. This is the dollar yen, of course, falling because it shows the Japanese yen strength. Well, now it's the opposite, Guy. The dollar is starting to dominate the yen. It almost begs the question of whether or not we are going to see some sort of yen carry trade for the risk rally that we've had recently, especially that AI and chip one you were talking about just a few minutes ago.
Yeah, everybody's getting excited about the dollar again. It's amazing to watch, isn't it? Complete reversal. But I guess on the rates narrative, maybe it does make some sense. Abigail, thank you very much indeed. I want to talk more about Japan. We have the perfect person on set to do that. Shoki Omori, Mizuho Securities Chief Japan Desk Strategist in London, joining us now. Very nice to see you.
Thank you for having me.
So a lot of people are trying to understand the Japanese market at the moment. International investors are getting very excited. But the thing that everybody's really struggling with, which I'm hoping you're going to be able to give us some insights into, is what is going on at the Bank of Japan. We did see Governor Ueda speaking a little bit earlier on today, talking about when rates are going to potentially change, when yield curve control is going to end. He said this: the key point for our policy decisions is whether inflation will rise at a stable and sustainable manner of 2%. How far do you think we are away from a policy change from the Bank of Japan? How much longer is yield curve control going to last? This is such a critical question for the whole of the world.
Yes, my base case for the BOJ is that they will take off YCC in October of this year. But for that, he needs to see, I guess, sustainable inflation, meaning looking at the core indices that not many people watch. Those are U.S. style core CPI and the BOJ weighted median CPI. And the CPI prints we are seeing are mainly in Japan style core CPI and core. So I think that's the divergence we see from the BOJ and the investor community. Right. So we have to see a little bit more of a strongest core CPIs.
But you think we're going to get that? So you think we're going to get that super core number is going to tick up enough? Where do you think it needs to get to? What do you think we need to look for that kind of that autumn fall switch from the BOJ to become a reality?
I think we need to see non-energy stuff, demand pull inflation picking up, because Governor Ueda has been repeating on TV and in Parliament that we haven't really seen demand pull inflation yet. It's mostly cost push. And he is very cautious because back in '98, when he was the board member, he really, when the BOJ hiked rate, he was against it. And I think he has the mindset that Japan might fall into deflation or slowflation when the trend of inflation isn't strong and long enough.
So, Shoki, it's Kaylee in Washington. What does this mean then for Japanese assets? What are the implications for the JGB curve, but then also Japanese equities? Have they gotten too far ahead of themselves in the near term?
For rates, yes. I think there is real demand in the belly as well as in the long end. So these kind of Japanese investors who are repatriating money from the U.S. market into Japanese JGBs, so they are going to be supported. As for equities, I think I am a little bit dovish on the equity side, because we've seen flows from overseas community shifting from U.S. or European equities into Japanese equities, so that could flip. Yeah. So that's the kind of a risk I see in equities.
Do you see that repatriation trade accelerating as we go through this year?
Yes, especially in the long end for JGBs, because life insurance companies, they need to buy the long end JGBs.
And what are they going to be selling? Where does that money come from?
So they have so-called underwater positions in treasuries, because they have been hedging, for example, 10-year treasuries for a long time. And, and it's under it's basically underwater and it's negative carry. So they have to be selling that and they have to be shifting that into JGBs. That's what I see.
Well, on the subject of Treasury, Shoki, of course, I'm here in Washington where we're all just waiting to see if we get a deal on the debt ceiling. We've been hearing from House Speaker Kevin McCarthy talking about progress made last night and this morning, how he's going to work as hard as he can to get this deal done. But it does raise the question of whether or not the U.S. could ultimately default or get close to it. And I'm just wondering what the implications are for Japan as a massive holder of U.S. Treasuries.
I think Japanese investors looking at past are on the rather optimistic side of treasuries. I don't think many are looking at U.S. default at this moment. So that, though they have to, again, sell some of the treasuries that they still have, they're not looking into default, hopefully.
Kelly, Abigail just a moment ago brought up the dollar. The kind of flows you're talking about, the dollar's come back onto the front foot. How substantial are these flows going to be? What are the implications? How substantial could the implications be for the currency market?
So I think the ball is basically on the dollar side, to be honest.
That makes sense.
Yeah, I mean, 2-year yields. We had a strong PCE as well as manufacturing data today from the U.S. and as you saw, 2 years picked up, and if you see dollar yen, it went up to 140. So I think the ball is on the dollar side. But I do see some risk that they might go up to 150 when we saw the Minister of Finance intervening last year.
Been great to see you.
Yeah.
Thank you for your patience as
Thank
well.
you.
I know you came to join us the other day, and Kevin McCarthy was speaking. So thank you so much for coming back and joining us this Friday. It's great to see you, and great to get some insight into what is happening, particularly with the BOJ.
Thank you.
Shoki Omori.
Thank you.
Chief Japan desk strategist, joining us from Mizuho Securities. Kelly, this is a really interesting point, and this whole flow story I think is going to be fascinating. The Japanese, in some ways, the BOJ in so many ways, is the holdout, and it's interesting to hear Shoki talking about the fact that the BOJ is still not convinced that inflation is embedded in the Japanese economy, that it's still the supply side that's causing the problems.
Yeah, and it's so interesting to contrast that with the picture here in the U.S., guys. We see PCE data this morning showing persistent inflation, and once again, we're talking about how the Fed may be hiking this summer and may not be cutting this year. The divergence in the monetary policy path, definitely very stark.
Absolutely, and Dominic Dwork just a moment ago talking about the idea that we could be getting up towards 7-8%. The market definitely ain't there, and I just think you could really end up with an interesting scenario. The BOJ pulls YCC a little later on this year. The Fed's going to be hiking much more aggressively. That could be certainly setting us up for some significant turbulence towards the back end of 2023. Anyway, much to discuss. We'll carry on with the conversation. This is Bloomberg. Forget the question of the day, it's risk on. We're risk on into this long weekend, going into the United States Memorial Day holiday. The UK's got the day off on Monday as well. Equity markets are really gaining traction. US markets are absolutely flying now. Equities definitely on the front foot. Tech is leading. Stock 600 up by 1.3% right now, 462. Caution is being thrown to the wind. It looks like we're maybe getting a deal. The consumer is in fine fettle. Everybody wants to go and enjoy the weekend. Next week, we'll see whether there's a hangover. Stock 600 therefore up by 1.3%. The dollar's on the front foot. We're just north of 107 at the moment. As you can see, are we going to get a break below that? That's quite significant. That's really something you want to pay attention to. We're going to talk about the potential for a European recession in the next hour. Jeremy Hunt would rather have a recession than maybe have the high inflation that we're dealing with in the UK right now, it seems. Anyway, single stocks, there's plenty to talk about. Rio is certainly one of them. Metals are on the upside today, 3.61% to the upside, Rio Tinto. We are actually seeing physical metals coming back a little bit today, but also there's a Morgan Stanley upgrade on Rio Tinto that's having a positive effect, basically saying that the recent underperformance is an opportunity. Anyway, we'll talk all about this. Why are stocks not going down? That is a key question for Sebastian Redler, Bank of America head of European equity. We are going to be talking to his next. The close is coming up. This is Bloomberg. Friday, the 26th of May. Risk on is the sentiment, and you can certainly see it here in Europe with the stock story. The DAX is up by 1.3, the CAC up by 1.4, the FTSE 100 up by 1%. The standout story is actually Turkey. Turkey has had a really decent rally into this weekend. Remember, we've got the runoff for the Turkish elections this weekend. We'll get the results early next week. We'll talk about that a little bit later on the hour. But as I say, it is risk on into the weekend. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So risk on into the weekend. It's a long weekend for the FTSE 100. The Stock 600, though, is up by 1.32%. Rio Tinto is up by 3.5%. Metals are coming back, but there's a positive note out from Morgan Stanley, which is certainly helping that stock. But the AI trade continues as well. It was there yesterday, and it continues today. ASM International up by another 7.7% today. I know Marvell is having a very good day over in the United States. But Europe has some tech too. Europe has some AI too. The question is, which is the right place to put your money? Well, certainly today the market is voting with its feet, Kaylee. 7.9%. I'm pretty sure you can trump that, though. You can beat that.
Yeah, certainly when it comes to Marvell Technologies, because check out this 27, almost 28% move as the company is saying that it expects AI revenue in fiscal year 2024 to at least double. Those are the magic words, Guy. And of course, the broader AI boom is what is leading Citi to upgrade its outlook on both U.S. stocks and technology, specifically to neutral and overweight, respectively. And really, we're just seeing broadly a lift in stocks to end the week, head into a long weekend. It has been a very long week, Guy. But of course, we still have the debt ceiling drama hanging over our heads, and yet it doesn't seem to be dampening risk appetite. The S&P 500 up 1.2%. The NASDAQ 100, aided by the likes of Marvell, up 2% on the day. And then we have to point out the bond market move as well, up 5 basis points on the 2-year Treasury yield to 4.58. Remember, we got hot PCE and consumer spending data, and it teased up potentially more hikes for the Federal Reserve.
Talking of more hikes, that has been the story here in Europe as well this week, Kaylee. The UK absolutely front and centre in this narrative. You have the UK inflation data, which came out really ruffling a few feathers and causing a significant shift in pricing. This week alone, the UK 2-year 55 basis points to the upside. We're now pricing 4 more hikes, 25 basis point hikes in for the UK. It's not just the United States that is seeing a significant repricing. The UK market, the Bank of England, is seeing that significant repricing. The question is, does the Bank of England have the support of the political leaders in Westminster? Well, Jeremy Hunt, the UK Chancellor of the Exchequer, was asked that question a little bit earlier on by Sky News. Basically, they asked him the question, would you prefer to see inflation remaining high, or are you prepared to tolerate an inflation to bring it down? And this was the question that was asked. Are you comfortable with the BOE causing a recession? His answer, yes. He'd rather see a recession than the ongoing issue, Kaylee, with high inflation. And it does seem as if the Bank of England has got the political backing and maybe the market backing as well to hike significantly from here. That opens up a big question about the whole of Europe. Germany's in recession. What about the rest of it?
Yeah, I mean, it just kind of raises the question as to whether or not Hunt is saying the quiet part loudly. And this brings us to our wider question of the day, as you allude to, Guy. Does Europe need a recession? Joining us now to discuss is Marcus Ashworth of Bloomberg Opinion and Philip Aldrich of Bloomberg Economics. So, Marcus, let's just start with you. Is your answer also yes?
I don't think we would need a recession. Whether it's going to get one, whether it likes it or not, is more likely than not, I think. Germany, as we've outlined, is already tipping into a technical recession, and a lot of the indicators, particularly manufacturing orders, show that their model of input of Russian cheap energy and exporting to China has broken down. If Germany goes into recession or furthers into recession, the chance of it tipping over to the rest of Europe are much higher, particularly as the European Central Bank is determined to keep on raising interest rates, as it now seems the Bank of England here is in the UK. One begets the other. Of course, overriding all this is actually, depends on what the US gets up to. If that goes into recession, the whole question is moot, because we'll be dragged down with it. But at the moment, something is going to break. We've seen signs of things breaking in the US banking system. Credit Suisse, our very own gilt market is now back up to where it was theoretically broken only a few months ago. Something is going to go bang at some stage, and we're all going to look back on things. Why are we not looking at forward inflation, and indeed only a third so far of the tightening has come through in monetary lag? It's madness.
Philip, does something need to go bang, though? does something need to break? In some ways, is Jeremy Hunt saying what Andrew Bailey should be saying?
Yeah, I mean, the job of the Bank of England is to basically take the demand out of the economy. And we saw retail sales today. Demand is still pretty strong. Inflation is out of control. As far as the bank is concerned, it's still out of control. They should be saying, or they can legitimately say, we may need to push this economy into recession. That is what our job is. Does it have to go into recession? Actually, the Treasury can, the government can take countervailing measures. They can put things like an energy price cap, fiscal support for households. Energy price cap can bring inflation down. Technically, that even gets into the stubborn, sticky side of inflation as well. So there are little levers that they have pulled, price cap being a price control, to bring the headline measure and the underlying measures of inflation down. But yeah, it's got to be a risk. It's got to be a risk now that there's going to be a recession.
Well, Philip, kind of carrying on that idea, at a different part of that interview with Jeremy Hunt, he said it's not a trade-off between tackling inflation and a recession. In the end, the only path to sustainable growth is to bring down inflation, and that is something that Fed Chair Jerome Powell has reiterated time and again too. But I just wonder, in this world when inflation is proving so persistent and yet growth largely, and we're seeing this in the U.S., seems to be hanging in there better than expected, if that's still true, if we could end up with both at the same time.
Well, I think the implication from what he was saying was that we could end up in a period of stagflation, where we just end up with zero growth and high inflation. That's the sort of counterpoint which we're worried about. There is, you induce a recession to kill off inflation to get back to sort of stable growth. That's the vision. That's the aspiration here. It has been the playbook of central banks in the past. I mean, that is how they've acted. And what's interesting is it's Hunt is giving the Bank of England cover, where the Bank of England has not been bold enough to say itself what its objectives imply, that it may need to push us into a recession.
Yeah, it is the bank's job to take away the punch bowl. That has always been the phrase. Marcus, the issue of recession or stagflation, isn't a recession better than stagflation?
No, because you can't control recessions in the way that clearly the Bank of England or even Jeremy Hunt seems to think is so blithely easy. No doubt about it. Sunak as Chancellor overstimulated the economy via furlough by not stopping it quick enough, and just as guilty, if not possibly increasingly more guilty, is the Bank of England. Complete failure over the last 2 or 3 years, and it's admitted its models are broken, of underestimating inflation and indeed growth as well, and letting it all rip, and then we are now paying the price. This started off as being exogenous, external inflation caused by energy, which they've no real control over. It's now turned into something a bit more sticky, but a lot of this data is backward-looking. Even under their own admission, they know they've done for 18 months worth of hikes, that this is going to lag through for many more months before we can see the real effect of it. And their own forecasts show they'll get inflation back under control. There is a risk here of actually overdoing it and creating deflation again, because they're lurching from one last crisis to the next without actually looking forward to what they should do. They should be pausing rates, watching to see what happens.
Well, and Marcus, your Bloomberg opinion column out on the terminal and online today is talking about how the gilt market is becoming unreadable for some of what you're talking about here. So where should we be looking for actual readable cues?
Well, I'm certainly not the central bank, it would seem, and it's slightly worrying that our politicians, we like them to be honest with us, but I thought Hunt's comment was perhaps a little bit too brave. There is a tone deafness going on throughout, not just the chief economist or the Bank of the Bank of England, but also sometimes our politicians here. This is not helpful to smash an economy and killing of demand growth when stuff it's pushing up is coming from external.
Philip, one final quick question. Is the UK on its own here? Is this the same problem that is going to be found in the rest of Europe? Germany is already in recession. You could argue the rest of the Eurozone may follow. Are there similarities? What are the similarities? What are the differences?
Well, you can see that there is stickiness in the European inflation readings as well. It is not as sticky as in the UK, though. They don't have the same labour market problems. They haven't got the shortages that we've got. Brexit is a contributory factor to food price inflation. We do have a unique situation in the UK relative to the Europeans. So Germany, yes, the big risk is the big economy, big European economy. It could bring everyone down with it. Another big risk, LDI scandals. I mean, LDI blow-up type events. But I would not presume that the eurozone is going to go into recession at the moment.
Great stuff, guys. Thank you very much indeed. Have a great long weekend. Marcus Ashworth, the Bloomberg Opinion. Bloomberg's Philip Aldrich on the economic side. More to come on our question of the day. Does Europe need a recession? Sebastian Rehler has been fairly cautious on European stocks for a while. We'll get his take on what is happening here. He joins us next. Bank of America's global head, Bank of America Global Research Head of European Equity. I always get that wrong. Such a long title. We'll shorten it down next. This is Bloomberg. Okay, let's get back to our question of the day. We've just been discussing it. Let's carry on the conversation from a different angle. Does Europe need a recession? Is it going to get one? And how are European equities going to be reacting? Sebastian Rehler joins us now. He's the head of European equity strategy at Bank of America Global Research. Nice to see you. You've been quite cautious on European equities for a while. They've held up. They've held up and they've held up. Why?
Because they are tracking very mercifully. They're tracking their typical relationship with macro momentum. Macro momentum has still been strong. And in fact, that's the number one feedback we get from our clients. How has the weakness in the credit cycle that we're seeing in Europe and in the US, why has that not translated through to weaker macro momentum? We think that's because A, there typically is a lag, and B, there have been a lot of tailwinds for the economy. But we think now the full impact of credit is coming through. The tailwinds are fading. So we see 20% downside for the market, and it will happen the moment that the macro momentum goes down.
Is that 20% downside base case include a recession, Sebastian?
Yeah, that's a hard landing scenario. And if you look at the credit conditions in Europe and the US, if you look at money supply, which is collapsing, you currently have in the US minus 10% M1 growth. You have to go back all the way to 1932 to see this kind of drop in liquidity available to the private sector. And you see negative credit impulse in Europe and in the US. These are clearly recessionary signals. And we think the rest of the macro data, so PMIs and GDP growth, will follow.
You get another 50 basis points from the ECB, maybe 75. You get another 100 basis points from the Bank of England. how much worse is that going to make the scenario? Is that going to produce the hard landing scenario you're talking about?
I think the hard landing is already in the pipeline. The real problem, I think this is basically the icing on the cake. The real problem the global economy has is that the Fed fund rate has just gone up by 500 basis points. You would have to go all the way back to 1980 to see such an increase. And you know what happened in the early 1980s to the US economy. This is one of the top 3 tightening events that you've seen at any point over the last 70 years. And it's just such a powerful and reliable lead indicator for the economy. But it works with a lag. It typically takes 10 months for the impact to come through, which means we should see it over the next 2 quarters.
Well, and of course, as we're talking about things that are happening with a lag, there's also things that seem to be happening at lightning speed. Guy, as we're talking, I keep looking back at the chart of Marvell, up 25% on the day because of the AI boom it's expecting to receive. And of course, it brings me back to the Citi note out in the last 24 hours talking about upgrading U.S. tech and U.S. stocks more broadly because of the expected benefit from AI. I wonder how that contrasts with the picture on your side of the Atlantic.
Well, we do have some tech. We do have some AI. Take a look at what's happening with ASMI here today. Yeah, precisely, not as much. We were talking about this yesterday. It's a huge competitive advantage of the United States. So, Sebastian, to Kaylee's point, are we going to see Europe once again underperforming the United States because of tech?
I would say you will see Europe underperforming in that scenario that I've just described. And again, tech is just the icing on the cake. Europe is a cyclical trade and it's a value trade. It absolutely loves an environment of strong macro momentum and rising rates. So for as long as inflation is the problem, everybody has to hike. Europe has outperformed just now by one of the largest amounts that we've seen over the last couple of years because it benefits from strong growth momentum, rising rates. The environment we are describing is one in which central banks realize they've over-tightened and they have to paddle backwards. That means weaker growth, lower rates. Europe already underperforms in that environment. And if you're then also missing out on the big structural story, which is AI, that is just one more catalyst.
Well, and talking of catalysts, I'm watching the heads come out from Cleveland Fed President Loretta Mester, who was talking about how everything is on the table at the June meeting. She says the Fed is not yet at the point where the next move could be up or down, which I guess indicates that it's either going to be up or stay. But in that kind of world where we are repricing in real time what our expectations of the Federal Reserve's path was, Sebastian, how does that filter through back to Europe? You were touching on it, but if you could just elaborate given the latest heads out of Mester.
Well, there's obviously what central banks are telling us and then what they're going to do. Remember that in early 2022, they expected 50 basis points of hikes. They ended up hiking by 450 basis points because the macro changed. And so what we're saying, the macro is going to change. You're talking about more hikes in an environment where the unemployment rate is still at a 50-year low and initial jobless claims are low and GDP growth is still positive. What we're saying is if you fast forward 2 or 3 months, very likely you're going to see weakening growth, cracks in the labor markets, fading inflation, and then they will talk about cuts, but they will only respond once it's visible in the data. And so therefore we'd say that from here they're likely going to start cutting in the third quarter, but assuming that effectively the macro, i.e. the growth and inflation are moving in line with our expectations.
What are you plugging in for China and what is the relationship to Europe?
Yeah, so we said the macro is still holding up because a number of tailwinds presented themselves. End of the euro area energy crisis, China reopening. Companies had very large order backlogs, which really is a very unusual feature which boosted activity. And we're saying every single one of these tailwinds is fading, and China reopening is one of those. Basically, you have already fully reopened, mobility has normalized, but now you start the data starting to sag. You've gone from fizzling, from sizzling effectively to fizzling. You're starting to see the nice turn of phrase. Huh?
Have you used that in a note yet?
I just brought it for you. It's like the and you see the macro surprise is fading. So the reopening boost in China is over. The credit cycle is not kicking in, and that is one of the tailwinds that is now in the process of disappearing.
All right, Sebastian, we got to leave it there, but thank you so much for joining us with your insights today. That's Sebastian Redler of Bank of America Global Research. And Guy, just to reiterate that we are hearing from Cleveland Fed President Loretta Mester at the moment. She said the PCE data from this morning confirms that inflation is still too high and that the slow progress on inflation is concerning. And as I said, she says everything is on the table at the June meeting. They are not yet at the point where they could move up or down. And she says interest rates are in restrictive territory, which is kind of the interesting last little leg of that.
I think the Fed's gone from fizzling to sizzling, the other way around. Basically, we've gone from everybody expecting that we're going to be seeing no rate hikes and cuts. We're sizzling again now, aren't we?
Guy with the wordplay on a Friday. I love it. Coming up, we have more to talk about.
It's not mine. I just stole that.
Yes. with a little gusto. All right, we're going to change topics coming up. U.S. regulators are looking into a bond trade popular with a lot of hedge funds. We'll have more on why this strategy is spooking the watchdogs next. This is Bloomberg.